Right, so we're doing some practice questions on chapter 16. I went out and checked the test bank and pulled as many of the examples here for learning objectives 1, 2, and 3. And so we'll go through some of those questions. And normally I give you a few minutes to work on it, and then I'll come in and do the answer. So hopefully you've had time to look at number 1. And so number 1 is asking the entry to record the purchase of bonds. And so purchase price equals, you had 1,200 times $1,000 times 0.97. And that's 1,164,000. And then we have to add the interest accumulated. And so we have the value of the bonds. 0.09 is the interest rate. And then it says that interest is paid on October 31st and April 30th. So they bought it on August 1, 2025. So in between those dates, they have April 30th. So we have May, June, July for the months. Bless you. And the interest is paid twice a year. And so when I put in 3 divided by 6, I get 0.50. And so multiply all this out. And we get 27,000. So we add that up. And so we would have a debit to investments for 1,191,000. Oh, I'm gonna add that up. I'm sorry. So we would have a debit to investments of 1,164,000. And then a debit to interest receivable for 27,000. And a credit to cash for 1.191 million. Okay, and so that is answer C. Any questions there? No, I started to misspeak Oh, sorry. These two are almost exactly alike and I just misread them. It's supposed to be interest revenue. Good catch. Thank you. So it's C. Okay, take a look at number 2. I'll give you guys about 3 minutes and then I'll go through it. And you guys can correct me on it. I'm gonna walk around and peek, see what you got for the answer. No, then like when they say they buy it at 0.97, so it's just you multiply by 1.2. So like 0.97 is just below 100%.
It just says purchase volume.
Right, so
I just assumed it meant.
at face value would be 100. And so under that would be a decimal over that premium, so.
That's what I figured.
Okay, so it says the amount to record on this long-term investment. Okay, so we gotta account for what our purchase was. And so it says that we purchased $1 million face value, or purchase bonds of the face amount of $1 million. And we purchased at 102. And so our price is going to be $1,020,000. And then we're gonna add the brokerage costs. And those are 15,000. And so our total is going to be 135,000, or 1,035,000, so letter B. The interest for 3 months is part of our entry, but it doesn't affect the cost. And that's the kind of mistake that I made before I started to shove it all into costs. Take a look at number 3. And as always, if you have any questions on any of these as we go through, please ask. And you can talk to each other and work with each other. This is not a test or an exam. Okay, so if we take a look at this, it says that the company purchased 1.5 million of 10% bonds on January 1, 2025, paying 1.41,375,000. The bonds mature on January 1, 2031. Interest is payable each July 1 and January 1. The discount of 89,625 provides an effective yield of 11%. Patton uses the effective interest method and plans to hold these bonds to maturity. So on our start date, we have a balance of 1.41,375,000. Our payment is going to equal that times 0.11, divided by 2. And so that should give us a payment amount of 77,570. Our interest, we take the 1.41 million and multiply it by 0.045. Oh, no, I'm sorry. 11, so 0.055. Sorry, this is the 1.5 million face value. Made a mistake on that. Times 0.11 divided by 2. I think I had too many zeros in there. Somewhere I made a math error. Okay, there we go. Sorry about that. All right, so what we have here to calculate it is we take the payment amount we take the 1.5 million face value, we multiply it by 0.11 divided by 2. Sorry, that's 10 divided by 2 because we're using the face value. This is 0.05. And so we get a payment of 75,000. And our interest we calculated, that's the 1.4 million multiplied by 0.11 divided by 2. So it's 0.055. And so that difference is 2,571. So the answer is D. Any questions? All right, so let's try number 4. come around in a minute and see what you got. Bless you. Okay, so it's asking you what amount is reported for other comprehensive income at December 31st, 2025. So it tells you beginning balance is 50,000. And we add unrealized holding gains for debt securities. This over a little bit. And that is 30,000. The other two items, one is a realized gain, so that would flow through our income statement already as a gain on the sale. And then the unrealized holding loss on available for sale equity securities is treated also through income. So it will go through income. So our ending balance equals 80,000. Any questions? Okay, let's try number 5. Okay. Anybody need another minute? This one's a challenge, I'll admit. All right, so it's asking for the gain on the sale, so we need to compute the book value. So we had 6,000 bonds that were $1,000. And so that comes out to be $6 million. But we paid or at least we have 5,880,000 . Of 5,880,000. So our discount as of 12/31/25 is 120,000. Okay, and on January 1 or December 31st, 2025, or January 1, 2026, it looks like we have 50 months remaining. Okay, so that's the 4 years, 2026, 2027, 28, 29, and then the first 2 months of 30. So we have 50 months remaining. So straight line amortization of discount. We take the 120,000 and we divide it by the 50 months, and we get 2,400 per month. We have 8 months in 2026. So we multiply that by 8 and we get 19,200. So we add the discount amortization to the balance. And so we have the 5.88 million plus the 19,200 gives us 5.899200. September 1, 26. And we need half of that because it's selling 2,000 or 3,000 of that. And so our value is 2.949600. Our proceeds from sale $2,964,000. So the difference, in this case, 14,400 is a gain. So that's a tough one. Any questions? Okay, let's take a look at number 6. Okay, so it's asking which of the following journal entries. And so we have to look and say, okay, we have equity securities, fair value 160,000. The cost 132,000. So the difference is 28,000. But we already have a debit balance of 8,000. So minus 8. And so this is our adjustment needed. And so our entry is going to be a debit. Did I skip one? Bruh. Why'd you guys yell at me? All right, never mind. I'm reading the wrong lines. You can tell my mind is on the election. We won't talk about that. All right, so I am working on 7. I'll apologize. I'll go back to 6. All right. So that is an unrealized gain. So our entry is going to be fair value adjustment of 20,000 and credit unrealized holding gain or loss to reflect the gain of 20,000. So that is letter B. Let's go back to number 6. Okay, Instrument Corporation has the following investment, which was held throughout 2025 and 2026. What is the amount of gain or loss would Instrument Corporation report in its income statement for the year ended December 31st, 2026 related to this investment? So the value at 2025 was 1,200,000. The value at the end of 2026, supposed to be 12/31, is 1,140,000. So the difference in 2026 equals a $60,000 loss. And so that would be letter B. Any questions on number 6 or number 7? Okay, let's try number 8. How many of you need another minute? So you guys still working, so. I will give that to you. Okay, so we have to remember that we compute gain or loss based on the cost and adjust the fair value adjustment slash unrealized holding gain or loss accounts at the end of the year. So we compare our proceeds, and our proceeds says we had 80,000 shares. And we received $17 per share. Multiply that out, 1,360,000. But we have to subtract, less it's commissions or fees. Brokerage commissions. And so that's minus 56,000. So our net proceeds $1,304,000. Our cost, which we are comparing it to, is $1,260,000. Okay, and so the difference is a $44,000 gain. All right, let's try number 9. Any questions? How many of you knew how to tackle this one? Good. Okay. So, I mean, really, they want you to go backwards, right? They're asking for the beginning balance is what? And so we don't know, but we know that we add to the beginning balance in investments, our portion of the net income. So it says 1,260,000, and we bought 0.25%. So that's going to increase it by 315,000. And we're going to have to deduct our portion of the dividends. Remember, because dividends reduce your equity balance. And so the dividends were 540,000. Our percentage was 0.25. So, and then we know that the ending balance is, they said 960,000. Right? Okay. So we basically have X plus 315,000 minus 135,000 equals 960,000. So we combine our like terms and we get 180,000. So we're going to subtract 180,000 from both sides. And we get X equals 780,000. letter B. Any questions on that one? Okay, 2 more to go. All right, so I ask a question of you. Based on number 9, what do we know is going to affect our net income? Or in this case, investment income? So not so much income, right? Because my entry for dividends is a debit to cash. Right? And a credit to my investment. Right? So this, so for equity investments, it doesn't hit income. Only the portion of net income attributed I'm looking for the name of the company. What's that? Oh, darn it, I did it again. It's not pod. Only the portion. Affects the income. So in this case, we had a $500,000 net income. And then we had 25,000 shares owned, 100,000 shares outstanding. So if we take the 500,000 multiply it by 25,000 and divide by 100,000, we get 125,000. Because they own 25% of net income. And then the last one, number 11. Okay, so it says during 2025, or sorry, Harrison Company owns 20,000 of the 50,000 shares, so ownership. Is 40%. Our beginning balance is 750,000. We add net income. No, yeah, so our portion of net income. So that's 1.2 million. That's 480,000. And then we deduct the dividends. And so the dividend's 960,000. And that's 384,000. And so our ending balance is 846,000, or letter C. So we got through the material quickly. I didn't feel like I had enough examples on it. I wanted to pull some moderate to difficult ones to challenge you guys on these. I feel like you've seen a bunch of examples. We'll have the chapter 11 and 16 test this weekend, and I'll start chapter 12 on Thursday. Any questions? Yep.
The other question I realized that because on the first one, right? So
Yep.
it was debt investments, interest, revenue, cash. Debit to debit to interest, revenue, and credit to that.
Correct.
Okay, because for what reason I had that wrong.
I originally put interest receivable. Some companies will use interest receivable, but most of them put it in as negative revenue. A debit to a revenue account, right, reduces it. So what's going to happen is in the middle of that year, they'll get that revenue, they'll report the full revenue amount, but that'll automatically reduce half of it. So that's why they do it that way. I prefer to see it as as a receivable, but that's in my head. No problem. All right, I will see you guys on Thursday. Hopefully by then, we'll know who's going to be our next president.